Hey everyone, today we're diving into a really cool investment strategy called CBVR. And what makes it interesting is that it's not just about picking winners. It's designed to learn and evolve with the market.
You know, if you've ever dipped a toe into investing, you've probably hit this wall of confusing questions. Do you go all in on one stock you think is a genius pick, or do you spread your money out? Do you follow the crowd, or do you bet against them? Honestly, it's enough to make your head spin.
So let's start right there, at that confusing crossroads. Why are these classic debates so incredibly hard to get right? Well, these debates feel like a trap, because they pretty much are. The right answer is always crystal clear when you're looking in the rearview mirror. Of course you should have bought Apple in 2002. But that kind of hindsight is totally useless for making your next move. It doesn't help you see what's coming.
And this is where the entire philosophy behind CBVR takes a sharp turn. Instead of getting stuck on those old questions, it says, hey, what if we're asking the wrong thing entirely? And there it is. That's the big idea. CBVR totally reframes the problem. Stop trying to be a fortune teller who predicts what to buy. Instead, focus on building a smart system for how you manage your investments. The goal shifts from trying to guess the future to engineering a system that can adapt to whatever the market throws at.
So, how does this system actually work? Let's pop the hood on the original strategy, CBVR 1.0. At its core is this really clever three-filter engine that helps it navigate the market. These are the three pillars. You can think of them as three separate experts in a room. Before any decision gets made, all three have to give their input. Each one looks at the market from a totally different angle, and together, they make for a much more reliable decision. Let's break them down. First up, you've got the level filter. This one basically asks, so where are we right now? Is the market getting way too hot, or is it getting too cold? It's kind of like a financial thermostat. When things get overheated and prices are sky high, it dials back the risk. But when the market's cold and prices are low, it sees a bargain and starts buying. It's that classic buy low, sell high idea, but built into an automatic system. Next is the speed filter. This one's job is to ask, okay, but how fast are we moving? This is so important because it keeps the system from overreacting to every little bit of market noise. It only wakes up and triggers a change when there's a major move. It ignores the day-to-day jitters, which saves on trading costs and stops the strategy from just chasing its own tail. And the final piece of the puzzle is the trend filter. This is the objective voice of reason. It uses some pretty neat math to look at not just the market's direction, but also its momentum. It's asking, what's the real underlying trend here? This is the final sanity check that prevents the system from, say, buying into a looks like a dip when it's actually the start of a major crash. You don't want to be fighting a strong tide.
So that three-filter engine is pretty solid for most conditions. But what about those sudden out-of-nowhere market crashes? The big ones? Well, that's what led to the next evolution, CBVR 2.0, which adds what you can only describe as a financial airbag.
The upgrade is both simple and absolutely critical. If CBVR 1.0 is like a smart, all-wheel drive car that handles well in any weather, then CBVR 2.0 is that same car, but now equipped with an airbag system. It's specifically built to protect against those rare but violent market shocks that can just devastate a portfolio. So how does this airbag not just go off all the time? Well, it's got this really clever two-key system. It needs two things to happen at once. First, an internal alarm goes off if the strategy's own performance starts to sputter. And second, an external alarm goes off if a market fear gauge, like the VIX index, suddenly skyrockets. Only when both of those alarms are blaring at the same time does the system deploy the airbag. This dual-check logic prevents it from panicking and hurting returns during normal market turbulence.
Okay, the theory sounds great. The logic is smart. But let's get to the bottom line. How did it actually perform? Let's look at the numbers. So check this out. Between early 2020 and mid-2025, a time that was, well, absolutely wild for the markets, CBVR 2.0 delivered a compounded annual growth rate of over 35%. That's the average return it made year after year, compounding on itself. But making money is only half the picture, right? The other half is avoiding losing it. And this is just as impressive.
The system's maximum drawdown, which is the single biggest drop it took from a peak to a trough, was less than 17%. Now, to put that in perspective, major indexes had drops almost twice that deep in the same period.
And when you put it all side by side, the story becomes really clear. You can see CVR 2.0's annual growth just dwarfing the NASDAQ 100 and Codex 200. But then look at the drawdown column, a drop of just about 17% compared to over 31% for the NASDAQ. It even improved on the original version. And that last number, the Sharpe ratio, that's basically a measure of how much bang you get for your buck, risk-wise. And here, it's about double the NASDAQ's. Better returns for less risk.
This chart really tells the story visually. The orange line is the CBVR 2.0 system. Just watch what happens during the big market meltdowns. While the other lines, the market benchmarks, take these huge nosedives, the orange line just kind of sidesteps the worst of it. It takes a small dip and then gets right back to climbing. And that's the magic. By avoiding those catastrophic losses, it keeps its capital intact and can compound way, way more effectively over the long run. This really gets to the core of why this is so interesting. In the world of finance, there's a golden rule. If you want higher returns, you have to accept higher risk. It's a trade-off. But what CVVR 2.0 seems to have done is achieve both. That's the closest thing you can get to what people in finance call a free lunch, something you're not supposed to be able to find.
And this all leads to the final and maybe the most powerful idea behind this whole approach. It's not just about a fixed set of rules. It's about creating something more, something alive.
So the big vision here is not just a static machine. The goal is to create a living system. There's this concept built into it called recursive extensibility, which is a really fancy way of saying the system is designed to watch itself. It can learn from its own performance, see what's working and what isn't, and then adapt. It's not just following old orders. It's designed to evolve. And that leaves us with one last big question to chew on. What if the whole game of investing isn't about finding a crystal ball to predict the future? What if instead it's about engineering? About building an intelligent, resilient system that doesn't need to predict the future because it's built from the ground up to react, adapt, and ultimately to survive it.